Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Fannie Mae stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a small cap company, 1.6 billion market cap. They're trading at $140 a share and they have 1.2 billion shares outstanding. Fannie Mae is a government-sponsored enterprise. It was founded in 1938 during the Great Depression as part of the New Deal. The company provides liquidity and support to the mortgage market. It buys mortgages from lenders that conform to its specifications, providing them with cash to fund more loans. Either they hold mortgages in their investment portfolio or package them together into MBS, mortgage-backed securities, that it sells to investors. They did run into a lot of trouble during the Great Recession. It was placed under conservatorship of the Federal Housing Finance Agency in 2008. The FHFA has the power over the company's management, board, and shareholders. Fannie Mae does operate as a regular business, but the FHFA has the ultimate authority over its operations. It's pretty much the same thing as when a bank goes into conservatorship. It's taken over by the government or another bank. So the stock was removed from a major stock exchange. Now it trades OTC, over the counter. The US Treasury also has a senior preferred investment in the company, and it holds warrants where it can buy up to 80% of its outstanding shares at a pretty low price. So you have to be concerned about that too. Let's take a look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Look how much free cash flow they had in 21 and 22, over 40 billion. Still pretty high, over 10 billion in 2023, 15 billion in the trailing 12 months. They convert nearly 49% of their revenue into free cash flow. It was 150% in 2021. Kind of crazy, right? Net income is a profit or loss on the income statement. It's revenue minus expenses. That's pretty high as well. 18 billion in the trailing 12 months, 22 billion in 2021. Really high margins. They average over 50% the past 4 years. Revenue is the sales for the company, and that's pretty flat, from 31 billion to 31 billion. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows. Past year 4, that's 14 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $12 billion. We divide that by 1.2 billion shares. And we get a calculated stock price of $10. They're trading at $1, so they're trading at an 87% discount. It's a really strong buy according to the model. I couldn't find any analysts projecting their future free cash flows, so I gave them a really low number, under 1 billion, and they're still extremely undervalued. The main concern is the government controlling the company. But it is the US government, it's not like a foreign government. I do see a ton of upside, but I'm not sure if I would invest in the company. I'm a little concerned about the government taking them private again. There are 17 companies in the same industry as Fannie Mae, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. Look how much more they spend in CapEx than anybody else. 4.6 billion. You can sum up the other 16 companies and multiply by 10, and it's still smaller than Fannie Mae. They're really leveraged, debt to equity ratio of 50. For every dollar of equity, they have $50 of debt. They do not pay a dividend. They used to pay a dividend. Look at Greystone, 10.6%. They generate more revenue than anybody, more than double Freddie Mac, their brother company. They rank 6th in market cap, 1.6 billion. Look at these price multiples, all 0.1. When a company has a 0.1 price multiple, it's usually right before they go bankrupt. So either they're extremely undervalued or they're going bankrupt. It kind of sounds crazy, right? Either they're doing really, really well or really, really poorly. Not in between. Look how much revenue they generate, 31 billion, more than anybody else. They're not growing that much anymore. Their 5-year annual revenue growth rate is 6%, which is higher than the median. But we saw earlier, the past 3 years, they've actually come down in revenue. Let's take a look at their financials. We'll start with their income statement. First quarter of 23, first quarter of 24. The way mortgage companies make money is lending money out so people can buy homes. And their profit is on the interest rate spread. So when they lend money to somebody, that person pays 8% but they get the money at 5%, so their spread is 3% in that example. And they also make money on fees as well, but the bulk of these companies' earnings are on the interest rate spreads. So interest income, the interest they receive on the money they lend out, were $34 billion in the first quarter of 2023, now it's $37 billion. Most of that is mortgage loans, $35 billion. They may invest money into securities, so instead of holding cash, they earn interest on different investments, maybe money market investments. That was $900 million, and other $660 million. Here's a breakdown of the interest income, the $37 billion. $600 million is on cash and cash equivalents. So that's the interest they receive on the cash they invest. Maybe it sits in a checking account, maybe they put into a bond. They also receive $600 million from securities purchased under agreements to resell. $300 million in investments in securities, $567 million in mortgage loans, but most of their income is on mortgage loans of consolidated trusts, $35 billion. And the asset balance is $4.1 trillion. So in terms of assets, they're the largest company in the United States, 4th largest in the world. So they lend out over $4 trillion to different companies, so those companies have enough funding to lend more money out. Pretend you have $100,000 of cash to work with. That's the liquid cash in your life, in your savings account. You do have some equity in your home, you have equity in your car, but you don't want to sell your home or sell your car. So that $100,000 is all the cash you have to use. Say for example, your mother needs $80,000 and you give that to her. So she owes you $80,000. Say she pays you $1,000 a month for 80 months. That money is locked up. Even if it's 100% certainty she's gonna pay you, you have to wait to get that money. Same thing when a bank loans money out. They have to wait to get that money. So when a bank loans out money to so many people, all that money is tied up, so they don't have any more money to loan out. That's where a company like this comes in, buys up their loans and gives them the money to loan more money out. So they have $37 billion of total interest earning assets, and they earn 3.4% on average on that money. But to get the money to loan out, they have to borrow. They have short-term debt and they have long-term debt. They pay 4% interest on that debt, but that's a small portion of their debt, only $119 billion. A majority of their debt, $4.1 trillion, they pay 2.8%. So their interest spread is a difference between the 3.43% and the 2.83%. So they receive 3.4% interest on the money they loan out, and they pay 2.8%. So the spread is 0.65%. That's their net income, their profit, $7 billion. Last year was $6.8 billion. The spread was a little tighter, 0.63%. Let's go back to the income statement. So interest income, $37 billion. The interest they pay in their debt is $30 billion. So net income of $7 billion. They also make money on fees, non-interest income, $570 million. That tripled from last year. They have to pay their staff, so they have administrative expenses, $900 million. Treasury fees, $860 million, and various other expenses. So total expenses, $2.3 billion. Income before taxes, $5.4 billion. They paid $1.1 billion of taxes. Net income, $4.3 billion, up from $3.8 billion. And their shares outstanding are flat, $5.9 billion this year and last year. Let's look at a statement of cash flows. Operating cash flow, $7.1 billion, up from $4 billion. Investing cash flow, negative $12.2 billion. Last year was positive $18 billion. They added $130 billion of debt. They paid back $135 billion of debt. This chart shows us new housing by quarter the past 5 quarters. So in the first quarter of 2024, 346,000 of multifamily units, new multifamily units. 1.1 million of single family starts. They added 1.4 million new loans in the first quarter. That dropped 20% for multifamily, up only 1% for single family. GDP growth 1.6% in the first quarter. It grew nearly 5% in the third quarter of 2023, but GDP growth was negative the first 2 quarters of 2022. Remember 2022, that was a rough year. 2023 was great, 2024 is even better. Unemployment's still really low, 3.8%. It is up from 3.6% in the first quarter of 2022. Here's a breakdown of interest rates by bucket. 31% of people have an interest rate below 3%. So if you get a loan right now, you can't get below 3%. So some of these people had loans from 2019, 2020. That's why it's so low. The most common interest rate is 3 to 4%. As more people refinance, it's going to be higher because rates have come up a lot. 3% have an interest rate above 7%. 27% of all loans are Fannie Mae loans. That means 1/4 of the country is able to get their loan because of Fannie Mae. Ginnie Mae is even bigger, 38%. Freddie Mac, 26%. Only 9% private label securities. These are from institutions like JP Morgan. A good way to gauge future defaults is LTV, loan to value. The lower the better. For example, if you have a $100,000 loan, that's how much is outstanding on your loan balance for your home, but your house is worth $200,000, you have an LTV of 50%. Loan $100,000 over value $200,000. What if your outstanding loan is $100,000 and the value of your home is $500,000? You have an LTV of 20%, even better. But what if your home is worth $100,000 and you still owe $100,000? Then you have an LTV of 100%, which is only 1% of the population. And if your outstanding loan is $100,000 and the value of your home is $90,000, you're underwater. You owe more than the value of your home, and your default rate goes up quite a bit. So that's good, it's only 1%. Because initially when they give funding to somebody, the LTV is under 100%, but possibly over time, the value of your home goes down. Another gauge of defaults is FICO score. If your FICO is under 700, you're more likely to default than if it's over 700. Debt to income is another good indicator. If you have too much debt relative to your income, you're more likely to default. 98% of the loans they provide are for single unit homes. If you owned a 3-unit apartment building, you'd fall into the 2 to 4 units. That's only 2%. 91% of the loans are single family, 9% are condo or co-ops. 91% are primary residence, 9% second homes or investors. The biggest part of the US is the western part, 28%. Second is southeast, 23%, southwest 19%, northeast 16%, midwest 14%. The biggest origination year is 2021, 30%. 2020 was 23% of the loans. 2018 and prior is 21%. 19% of their portfolio is California. 10% of their delinquent loans is California. And serious delinquency, 39 basis points. Even though 10% of their loans are seriously delinquent in California, it's actually good for the state because the entire book is 19%. Florida is worse. 9% of their delinquent loans are in Florida, but it only makes up 6% of that portfolio. This is interesting. 68% of their book has an LTV below 60%, but 69% of their book is seriously delinquent. I would have thought it would have been lower. 2.1% of their seriously delinquent loans have an LTV above 100%, so that makes sense. Let me see if I could explain mortgage-backed securities concisely. Pretend you're John, you need to buy a house. So you go to your local bank and ask for a loan for $150,000. Say the house costs $200,000. You'll put $50,000 down, the bank will give you $150,000. So now you can get a home. But if your local bank keeps lending out money, they're not gonna have any money left over. So Fannie Mae comes in and gives them $100 billion. Obviously, Fannie Mae is not going to just give them money, so they want something in return. So your bank gives them $110 billion of mortgage loans. Your mortgage loan is part of that $110 billion. And the way Fannie Mae gets the money is people who invest in mortgage-backed securities. So they get the money from other investors. Let's pretend your bank is in Nashville, Tennessee. So Fannie Mae creates the MBS bond for Nashville, Tennessee Bank. So anybody could buy that bond in the open market, that MBS bond. And say a pension fund puts $100 million into this Nashville, Tennessee bond. The way they would get a return is when people pay their monthly payments like you. That money goes back to the bondholder. So the people that buy the bond are acting as a lender. They lend money to you through the bank, and they do receive a return on their investment when you pay your principal and interest payments. As long as not too many people default, you'll get a good return. But if a lot of people default, you may take a loss. But that doesn't happen too often. Most of these bonds don't default. Let's look at a stock on Simply Wall Street. Its last price $1.40, 8.4 billion market cap. It's a little confusing because the market cap on Yahoo Finance is 1.6 billion. That's what I used to make the video. So I'm not sure why Simply Wall Street is 8.4 billion. E-Trade's market cap is 1.6 billion. Same as Yahoo Finance. Let's just keep moving forward. Maybe it is a good investment. It tripled in the past year, up 200%. The stock peaked in 2000 and almost hit $90 a share. Even in 1990, it was about $8, $9. It got real low in 2008, falling below $1. In 2019, it got up to $4. Look at this, 35 cents at the end of 2022. If you were a genius and you picked it up then, let me know in the comments. You deserve it, congratulations. Simply Wall Street's value is $19. They say the stock is 93% undervalued. Two analysts priced this stock at $1.25. Two analysts project their 2024 revenue to be $29 billion, 2025 $30.6 billion. Their net income forecast for 2024 is zero, 2025 is zero. Their debt is $4.2 trillion. I've never seen a company with over $1 trillion of debt. Well, that's how they fund their loans, with all that debt. Equity is only $80 billion. They did have negative equity in 2018, and they only have $86 billion of cash. The CEO's salary was $46,000 in 2022. Now it's $600,000. Total compensation $700,000. Tenure as CEO 1.6 years. Employee count is pretty steady, around 7,000 to 8,000 employees. The ticker trades in the OTC Pink Sheets and London Stock Exchange. Let's learn about the history of the company. If you go back to the early 1900s, most loans were short-term with balloon payments. A balloon payment means all the principal is paid at the very end. As you can imagine, the Great Depression weakened the US housing market because so many people lost their jobs and were not able to make the payments on their mortgage. By 1933, 25% of the country's outstanding mortgage debt was in default. That means 1 out of 4 people lost their home due to foreclosure. To address this, Fannie Mae was established by the US Congress in 1938. That was part of FDR's New Deal. So now Fannie Mae created a liquid secondary mortgage market and made it possible for banks and other loan originators to issue more housing loans. For its first 30 years, Fannie Mae was a monopoly over the secondary mortgage market. In 1950, Fannie Mae was acquired by the Housing and Home Finance Agency. In 1954, the government transformed Fannie Mae into a mixed ownership corporation, meaning that the federal government held preferred stock while private investors held common stock. In 1968, it was converted to a privately held corporation. In that same year, Fannie Mae was split apart. There was now Fannie Mae and Ginnie Mae. Ginnie Mae is the Government National Mortgage Association, and that's a government-owned corporation within the Department of Housing and Urban Development, HUD. Ginnie Mae is very similar to Fannie Mae and Freddie Mac. The difference is that Ginnie Mae is a wholly owned government corporation, where Fannie Mae and Freddie Mac are government-sponsored enterprises, which are federally chartered corporations privately owned by shareholders. Ginnie Mae guarantees FHA-insured mortgage loans as well as Veterans Administration and Farmers Home Administration insured mortgages. To clarify, Ginnie Mae is the only home loan agency that is backed by the US government. Fannie Mae is not guaranteed. It's kind of quasi-guaranteed. Just like JP Morgan's not guaranteed backed by the government, but the government has backed them during the bailouts in 2008. In 1978, the federal government authorized Fannie Mae to purchase conventional loans that are not insured by FHA or VA. And this led to the creation of Freddie Mac, Federal Home Loan Mortgage Corp. In 1981, Fannie Mae issued its first mortgage pass-through and called it a mortgage-backed security. In the early 90s, President Bush really pushed Ginnie Mae to finance low or moderate income families. In 1999, Fannie Mae came under pressure from the Clinton administration to expand mortgage loans to low and moderate income borrowers by increasing the ratios of their loan portfolios in distressed inner city areas. In 1999, the New York Times wrote an article about Fannie Mae taking on more risk. They said the government-subsidized corporation may run into trouble in an economic downturn, prompting a government rescue similar to the savings and loan crisis in the 80s. The New York Times was spot on. They got that right. Another article by the New York Times in 2003 said the company is sitting on a barrel of dynamite that may blow up in the slightest hiccup. Now Fannie Mae was competing with investment banks who were taking on a lot of risk. These investment banks would offload the risk to insurance companies through credit default swaps, which made things a lot more convoluted and people didn't really understand what they were buying. By 2008, Fannie Mae and Freddie Mac had owned or guaranteed about half of the US's $12 trillion mortgage market. Everyone owned Fannie and Freddie bonds. The Chinese government, retirement funds. If they went bankrupt, there would be a mass upheaval on a global scale. Then everything blew up in 2008 when so many people defaulted on their subprime mortgages. In 2010, Fannie Mae stock was delisted. So since 2010, they've been trading OTC. The government owns so much of Fannie's stock that in 2013, Fannie paid the government $59 billion in dividends. But things have improved a lot the past few years. Since Fannie is a GSE, by law, Fannie has to provide liquidity to loan originators in all economic conditions. It must legally ignore adverse market conditions, which appear to be unprofitable. If there are loans available to purchase that meet its predetermined underwriting standards, it must purchase them if no other buyers are available. But the big benefit is Fannie Mae can borrow at a really low interest rate, lower than any corporation. Let me explain once again how Fannie Mae works. They purchase mortgage loans and then package those loans into mortgage-backed securities. They buy loans from approved mortgage sellers. Then they sell the mortgage-backed security to investors in the secondary market, along with a guarantee that the stated principal and interest payments will be timely passed through to the investor. By purchasing the mortgages, Fannie Mae provides banks and other financial institutions with fresh money to make new loans. They're such a big company, their asset base is higher than JP Morgan. JP Morgan, the largest bank in the world, and Fannie has more assets than them. In order for Fannie Mae to provide its guarantee to mortgage-backed securities, it sets the guidelines for the loans that it will accept for purchase. They call those conforming loans. The secondary market for non-conforming loans includes jumbo loans. Those are loans above $766,550. Fannie and Freddie do not purchase jumbo loans. In 2004, Fannie was under investigation for its accounting practices. There were widespread accounting errors. In 2006, they spent $1 billion to complete its internal audit and bring it closer to compliance. It ended up costing them over $6 billion when all was said and done. In December 2006, civil charges against Chief Executive Franklin Raines, CFO J. Timothy Howard, and the former controller Leanne Spencer. The three were manipulating Fannie Mae earnings to maximize their bonuses. The lawsuit recouped $115 million in bonuses from the trio. After 8 years of litigation, the case was thrown out. It indicated the government had insufficient evidence that would enable any jury to find the defendants guilty. In 2013, a former foreclosure specialist at Fannie Mae had been accepting kickbacks. The government is much more shady than for-profit organizations. So that's the end of the video. Let me know what you think. Thanks for watching.